Is the microphone on? Good afternoon, everybody. It is my pleasure today to introduce Professor Douglas Diamond as our first keynote speaker at this year's Monetary Policy Conference. Professor Diamond, currently at the University of Chicago Booth School of Business, is well known around the world as the 2022 recipient of the Nobel Memorial Prize in Economic Sciences for research on banks and financial crises. I do not have time to go through his fantastic career in detail, but let me emphasize that Professor Diamond is widely regarded, and for very good reasons, as the founder of modern banking theory. I'm sure we all know very well his contributions in this room. Professor Diamond has shaped our understanding of the role of banks in the economic and society. His studies have contributed massively to our collective knowledge in at least three main fields of economic and banking literature. First, the essential economic functions performed by financial institutions. Second, the vulnerability of banks to runs in times of financial panic. Third, the ways in which policymakers can improve the stability of banking systems. In other words, Doug Diamond's pioneering work on banking laid the foundation for much of modern financial economics research. I am particularly honored, not rhetorically, I'm honored to introduce Professor Diamond, as his work has also greatly influenced my knowledge and understanding of financial intermediaries throughout my career. With this, Doug, I do not want to blame you for what I have done in the past. Like many others, I have been influenced by his studies, both as a researcher, including during my graduate studies, and as policymaker. Today's keynote speech on interest rate risk, financial crisis, and bank supervision is particularly relevant in a context where many central banks around the world have been raising rates at a rapid pace. Drawing on the market turmoil in the United States in March 2023 and the rapid run on Silicon Valley Bank, today's lecture will focus on, first, how liquidity, credit, and interest rate risks are intertwined. Second, how supervisory actions can limit the buildup of financial stability risks. And third, how these risks, financial stability risks, interact with monetary policy measures. So let me thank you once again, Professor Diamond, for accepting our invitation to participate in the ECB's Monetary Policy Conference. And without further ado, I give you the floor. You have 45 minutes, after which we will have around 15 minutes for questions and answers. You have the floor, Professor Diamond.
Thank you very much for those kind words. Very happy to talk to you all today, and honored to give a keynote when the other one is Peter Diamond, who's not related to me, but one of the people I worship in economics. Bill Brainerd used to call me Peter when I was in graduate school, and I took that as a great compliment. I'm not a macroeconomist, as you all know, but I'll try to relate the US experience on runs on regional banks to both supervisory policy and a little bit out of my expertise to monetary policy, but I hope to provide a slightly different perspective. See if I can get my slide to advance here. So the question is, what can we learn more generally, if we're not just concerned about the US, from the stuff that happened last March in the US? So financial stability worldwide is in question. And this particular time, each crisis is a little different. The issue is interest rate risk and buildups of interest rate risk on fairly liquid securities. So this is a global issue because we know nominal interest rates are going up globally to deal with increases in inflation. And what's the general message here? I'll sort of give my views on how US bank supervision failed and what that can say to think about global supervisors. And in summary, we sort of saw the ex post, but I would argue also the ex ante problems with hold to maturity accounting, where you don't mark certain things to market, interacting with interest rate risks, which were unexpectedly large. So as a result, once the supervisors didn't essentially intervene to ask for more capital from what were in many cases insolvent banks, once the most basic parts of supervision break down, this thing that a bunch of monetary economists like to say is, well, we can separate financial policy, financial stability policy from interest rate, monetary policy, because we have macro-prudential policy in between to set up a firewall. Once that's no longer true, we find that there's a strong interaction between these two policy issues. So I'll go through, you've probably all thought about Silicon Valley. Well, I'll talk about what happened there. We'll talk about why the run there was so quick and contagious, and a little more speculatively, what we can say about Eurozone bank supervision, and even more speculatively, what we can say about monetary policy. So my summary of what happened in March of this year was there was a really rapid run on Silicon Valley. It was sort of a one-day run because the regular supervisors and regulators closed them on day 2 because there was going to be an even faster set of withdrawals. The runs spread to other mid-sized banks that had some of the same issues, but some of them didn't actually have the same issues. And the key thing that everyone notes is that over 60% of the Silicon Valley Bank assets were medium-term and reasonably liquid US government agency securities. So they didn't have a very big loan book. So interest rate risks, obviously, interest rate increases led to big reductions in market value of these securities. That became public information that there were reduced values. So they, in hold to maturity accounting, or for this bank, also available for sale securities that weren't marked to market, but turns out that wasn't much of an issue, as we'll see in a minute. The interest rate increases led to reduction of market values. Even though the regulatory capital wasn't adjusted, and the supervisory intervention wasn't quickly enough adjusted to these reduced market values. The public disclosure in the securities reports, we call 8Ks in the United States, from the disclosures to shareholders about market value, they had to disclose that effectively their net worth was negative. And when that was disclosed, even though it was sort of somewhat known already, the run started, it became discussed in social networks, Twitter and things like that. And people think of this as sort of a panic run, but when the disclosure is the bank is insolvent, I wouldn't call that a panic. That's not the fear of fear itself. That's the fear of staying in and losing money if you don't take your money out anyway. So it's sort of a dominant strategy to get out. So when this happened, Silicon Valley Bank fails. The FDIC ended up guaranteeing 100% of their deposits, even though it was exceeding the limit, which I'm going to argue was a very good thing that they did, a wise thing. It spread less widely than it would have otherwise. And then banks around the world start thinking about runs. We also had Credit Suisse in this same period. So first thing you want to note, and this is from the report of a report that Deutsche Bank put together, that basically, if you look at the size of the failed institutions relative to GDP contemporaneously, it was basically as large as those failures, those 500 failures during the Great Financial Crisis, almost as big as the savings and loan crisis, which was the last interest rate risk-driven crisis in the United States, and about a third as big as the failures in the Great Depression. So this was a big deal, actually. Even though these were mid-sized banks, the 3 of these banks that failed were pretty big in terms of asset size. So the supervisors didn't respond to their insolvency because they were looking at they weren't marking loans to market. The other thing the supervisors didn't look at was the extremely rapid growth. So we looked at, just the assets of Silicon Valley Bank. So compared to what they were in 2017, they were like 4.1 times as big in 2021, and most of this growth occurred very rapidly. So when I worked at the Fed as a graduate student, the man next to me was in charge of predicting bank failures. And he says, well, you can do a lot of data analysis, but the main thing that predicts bank failures, particularly from incompetent management, is really rapid growth of assets. So there were two things the Silicon Valley supervisors didn't respond to, maybe because they had been encouraged to use formulas rather than brains. But it seemed like it wasn't the case that it was at all surprising that Silicon Valley Bank was going to get into trouble. As I mentioned, the big thing that got disclosed is that they were insolvent. And just looking at their assets, 55% of their assets were securities that were not marked to market, and the vast majority of these were held to maturity assets. The blue stuff at the very bottom here is their available for sale securities that in this period, mid-sized banks like they were at the beginning of the period didn't have to mark to market, but because the vast majority of these things were held to maturity securities, it wasn't the special tailoring of supervision for mid-sized banks that kicked in a couple of years before this that was responsible. It was just the fact that they had lots of relatively long duration liquid securities on their books that they weren't marking to market. So Silicon Valley supervisors did not consider the market value of the securities, so their book equity at the end of 2022 was $15.46 billion, and their asset losses, their unmarked to market asset losses at the end of 2022 or early in 2023 was much larger than this. Okay, so just even their held to maturity assets had losses of roughly that magnitude. So the net worth was around zero. So why wouldn't you mark stuff to market? What's the idea? So one of the few things is hold to maturity accounting says, well, it's only a paper loss, so you can hold it to maturity. You won't actually have a loss. Well, that's actually wrong in present value terms. We'll see how that relates to what are called deposit betas in a minute. And maybe it makes some sense for illiquid assets. If there's really not a good market price to mark to, marking to market could be recording fire sale prices that wouldn't actually have to be realized. So maybe this idea it's only a paper loss might make some sense. But it doesn't make any sense for liquid assets such as US government agencies. And it probably doesn't make a lot of sense for Eurozone government bonds, which your banks hold a lot of. They're not essentially as uniform as US agency securities. They're not as liquid, but basically not marking things to market, if it gets to extreme, is asking for tremendous problems. It's counterproductive because a lot of the faith that depositors have, depositors who obviously do not monitor the details of what are going on inside of banks, a lot of the faith that depositors have is because they figure that the supervisors are doing the obvious stuff and making sure that the banks that are open and still operating and not raising more capital are well capitalized. So once it becomes knowledgeable, once depositors know that supervisors let insolvent banks stay in business, then these banks become very vulnerable to runs, and uninsured deposits really no longer become viable. We know deposit insurance in the Eurozone is at much smaller scale and less centralized than in the US, so this is particularly important in the Eurozone. So once you know that there are insolvent banks on there, runs are going to occur because runs on insolvent banks, runs on uninsured deposits on insolvent banks are essentially unavoidable. So let's just think about this. Once you know that banks that are insolvent will not, from things that are not marked to market, will not be closed, that has the bad ex post effect of having insolvent banks in business. It also has a very bad ex ante effect of encouraging banks to load up on this particular type of risk because they know that they won't have to raise more capital in the middle of a near insolvency period because their solvency is not measured in the proper way. So once you're encouraging banks to take interest rate risk, you're going to say, is this a good thing? Why do we have banks in the first place? And I'll just talk about, like, since they're my models or mine and Phil's models, these are not just models, but my views of why banks are around. So we can think that banks are important for small and medium business lending, the delegated monitoring thing that Diamond 84 does. So presumably US agency securities and even Eurozone sovereign bonds do not benefit from delegated monitoring by banks. So there's no social value in having banks take interest rate risk when it's just basically having them buy lottery tickets. So large interest rate risk bets are not diversifiable, and diversification is part of the magic of financial engineering that makes banking work. Banks don't create liquidity as they do in Diamond Divvy by holding long-term liquid assets. So maybe in the Eurozone, long-term governments in some countries are less liquid. So maybe there's a little liquidity creation and having banks do that. But deposit insurance or implicit guarantees should not be a way of encouraging banks to bet on interest rate risk. So Martin Hellwig has a very nice paper in 1994 that makes that very clear in the Diamond Divvy model. Other papers of his make it clear in the delegated monitoring Diamond 84 model. But more generally, this is not what the reason we have central banks, lenders of last resort, and deposit insurance. So this is the link that once supervision and other types of regulations encourage interest rate risk bets, you're getting away from the key role that banks are supposed to fill. So phase one of the Silicon Valley Bank crisis is the one that I just mentioned. Once people learn on Twitter or elsewhere that Silicon Bank is insolvent if marked to market, then that's going to start a run. But that's maybe not exactly true. So these are not default risk ridden securities. This is interest rate risk. So there's a thing that people always say, and it's sort of the whole point of not marking things to market, is that, these are only paper losses, so they're only insolvent if they have to sell the bonds. Okay, well, that's not quite right, because they're only insolvent if their cost of financing this portfolio at this new higher interest rate environment doesn't rise sufficiently to make them insolvent such that they're just without marking to market, just their funding costs go up. So mark to market insolvency is equal to bank insolvency, basically only if their funding costs are exactly going up with market interest rates, sort of their deposit beta, which is like the pass-through rate of market interest rates to deposit rates, is 1. So in the Silicon Valley Bank, deposits were actually flowing out well before the run, not because anyone thought that they might be insolvent. It was basically because of higher interest rates available elsewhere. Silicon Valley Bank was a highly unusual bank. So they had mainly demand deposits, checking account deposits from startup firms who had deposit balances in the tens and hundreds of millions of dollars. So this stickiness of wholesale deposits is basically not something that would be very relevant for when they're in the tens and the hundreds of millions of dollars. So it is the case that they already were having funding problems, not due to liquidity risk, not due to fear of insolvency, but just due to interest rate risk. So that's phase one. So let's look at so if the beta was 1, once their market value insolvent at mark to market, they are insolvent in every sense, but the betas are less than 1. So from the ECB May 23 Financial Stability Review, we can see some evidence on deposit betas in the ECB zone, in the Eurozone. And we can see that there was, in various periods, a pass-through. Now, if you look at the period, say, 2018 to today, you're not going to see very much pass-through of policy rates for two reasons. One is interest rates were falling during that period, so we know deposit betas are lower for interest rate reductions than increases. Second, deposit rates, the interest on reserves equivalent in the Eurozone was 0 or negative during that period, and it was very hard or impossible to pass through negative rates. So the pass-through is going to be very, very low in that period. Second, in the most of the period before that, we had periods of falling rates. So there were periods of increases, but they were sort of blips. So it's actually in the period where the euro has existed, not that easy to estimate deposit betas. But one thing we can see is that for non-household deposits that were overnight and things like that, they were actually fairly low. And the middle panel here, I don't know if you can see it, this is again from the May 2023 ECB Financial Stability Review. The estimates of deposit betas for overnight deposits of households or non-financial companies were well below 0.4. For term deposits, they're bigger, but again, it's very hard to estimate deposit betas from very, very large interest rate increases from periods where there were not very large unanticipated interest rate increases. So I would say I would be very careful about relying on even the upper bound of the confidence intervals of these deposit betas. Because as you leave interest rates, as the US did, interest rates higher for longer, this pass-through is going to go through. So not marking things to market is a very effective way of setting up financial instability. Okay. So this last panel on the right here, the C, that basically shows that the deposit rate pass-through is higher for banks that are less liquid. So that actually makes sense that if they're more reliant on using market liquidity to refinance, you're more likely to have to go and pay the marginal cost, a higher than a close to market rate. So there is some evidence in here that says you should be very careful, just like I think the US should have been much more careful in not marking the hold to maturity assets to market. And at very least, if you're not going to mark them to market, if you're going to say once the unrealized losses are sufficiently large to be a significant fraction of bank capital, you should have an extraordinary intervention to require more bank capital. Because the point is that uninsured deposits, even from companies which are in the US's treated as stable funding, are in periods when interest rates go up enough, are unstable funding. So essentially, Silicon Valley Bank had 94% uninsured domestic deposits, the vast majority of which were uninsured demand deposits. So their liquidity ratios and their net stable funding ratio looked wonderful because historically, checking accounts, demand deposits do not run, but not when they're as big as they were for Silicon Valley, and not when the interest rate paid on checking accounts is 300, 400, 500 basis points below market rates. Okay, so once we had these banks like Silicon Valley and First Republic having interest rate risk cause fears of losses to uninsured deposits and eventual runs, then people are thinking about runs. And then we're in a period sort of like we were after the Lehman Brothers failure in 2008, when depositors are thinking about runs. So first lesson of crisis economics, you don't want depositors thinking about runs. You want them thinking about something else. You want them thinking about where they're going to go spend their money or invest their money, or just thinking about how safe banks are or something like that. So there's danger when short-term lenders in general start thinking about runs. So one of the point of like all the research that I've done is that it's not so much about banks, it's not so much about money, it's not so much about cash in the vault. These problems are about fear of the inability of short-term lenders to roll over their debt. So that was after Lehman. We saw that in East Asia, which had some banks involved. It also had sovereigns. We saw this in the hedge fund sector in LTCM, and we see it now for regional banks. So here's the phase 2 logic. Once you're thinking about runs, then people are saying, I wonder if my bank would be solvent during a run. Okay, so the answer to that is always going to be no. So once you're thinking about that issue, you've basically lost the financial stability game. So you could be having them thinking about runs. They could be thinking about future illiquid asset fire sales at other banks. Silicon Valley didn't have very many illiquid assets, but other banks basically had lots and lots of those. Second, we can just think about contagion. Sunspots is sort of my term for contagion in this sense. Once you have runs by uninformed depositors on banks like Silicon Valley, they start thinking, uninsured depositors, or even insured ones sometimes, that we get irrational runs by uninsured depositors after there are runs. Once we get people thinking that other banks might be in trouble and they think they don't understand why, they might start just running more generally. We say, oh, the US banks failed, Credit Suisse, failed. That's going to lead to the runs. So there's a slightly more subtle argument that Zhang, Matvos, Pisortsky, and Saru had in a recent paper, is that even very liquid assets could have a fear of fear itself run, a Diamond-Dybvig run. Essentially, the idea is these liquid assets, when they were worth 100%, when they were selling at par, wouldn't ever be subject to a fear of fear itself run, because if you have 100 in deposits and 100 in assets, you can say, okay, even if everybody else pulls their money out, they could just sell those liquid assets. But once you're at a point where you have not marked to market these assets, which are very liquid, which were worth 100% when they were bought, now fall down to like 80% of what they're worth at market value. Even though you could hold them to maturity and get 100, if everybody thinks that there's going to be a run on this bank, even if the interest rate pass-through, the deposit beta, is not very high, if everybody thinks there's going to be a run on this bank and you can't sell the liquid asset for 100 for the value of deposits, that could cause a self-fulfilling prophecy run. So this is a little different from what I said. If the bank is just insolvent and the deposit beta is high, they're going to fail anyway, so it's a dominant strategy. Everybody should pull their money out even if they think they're the only one. But you build in this unneeded financial fragility by allowing these banks, even if the deposit beta was 0, allowing these banks to operate when they can't liquidate their assets for the value of the deposits. They then become subject to just a run, a fear of fear itself run on uninsured deposits. That's the extra more subtle point. So both of these points suggest that relying very much on hold-to-maturity accounting in bank supervision, regulation, and capital requirements is, again, a very effective way of building in instability. Okay, as I mentioned, the ex-ante effect of this, of not marking to market in the banking book, in the Eurozone terms, has two issues. It encourages banks to stay in, it allows banks to stay in business, and it encourages banks to take these risks. So unless there's a goal to encourage banks to hold more long-term government bonds, which I'm sure in the case of agency securities in the US is not the case. This increases the solvency exposure to interest rate risks. So once you're following this not mark-to-market thing, you're going to say if interest rates go up, we're going to have an unusually high solvency exposure to interest rate risks, which has lots of problems. Okay, so bank supervisors and regulators are not very keen on using market values because they don't trust markets, because it causes noise, because they think about hold to maturity and paper losses. The increase of this risk, or this increased solvency to interest rate risk exposure, the beta on this, the sensitivity on this is a problem. Why? Ignoring ex post or ex ante this very high sensitivity of very low market net worth of financial institutions, banks, this could also be true in the shadow bank sector, either gives you a supercharged effect of monetary policy rate increases via financial instability. So if you get to the point where the banking system is close to insolvent and you raise interest rates enough to make them actually insolvent, or a significant fraction of it actually insolvent, monetary policy will have a short and not very variable lag through financial instability. And presumably that's not the goal of monetary policy when you're trying to raise nominal and real interest rates to fight inflation. Okay, so that's option A, that okay, you can just cause a crisis. Or B, monetary policy can become constrained by the threat of financial instability. So once you're into this B, that you might lose some loss of inflation fighting credibility. And as I mentioned, once you're allowed the banking system become essentially insolvent, this idea that's so popular that you can use macro-pru to separate monetary policy from stability policy no longer makes any sense. So again, my message is, if you're going to have a period where interest rates are going to be, unstable and potentially increasing quite a bit, there's a huge risk in ignoring these market values because you're going to get this problem either A or B, and central bankers to a person don't like to admit that B is ever a possibility. There was a couple of weeks of this last year in the Bank of England's policy when they had their liability-driven interest rate problems. Okay, so that's the problem. So I'm making the case for more use of mark-to-market. So let me now speculate a little bit on how the United States got to the point where banks tremendously overloaded on interest rate risk without doing any increase in useful lending to businesses or consumers. Why so many of the banks had these very liquid portfolios that were focused on interest rate risk. So I'm going to follow up on an idea from some work that Raghu Rajan and I did in a JPE paper on interest rate risk and financial instability in the JPE. And basically, I want to argue that implicit promises of low interest rates for a very long time, or forward guidance, or maybe some versions of quantitative easing are going to lead to too much short-term funding, too much short-term debt, too much short-term, obviously, by definition, floating rate debt. So this promises of low interest rates for a long period, enforced either by forward guidance or by QE as a sort of money-back guarantee of the future commitment to low rates, even if there's a macro shock, is a wonderful feature from macro stimulation. Like when you're at the effective lower bound, you want to stimulate, say, hey, we're going to stay here, we're going to tolerate some inflation. So that's a wonderful macro feature. This is like free extra credibility because you can have people expect that if interest rates go up, you won't respond. But this is a financial stability bug. Forward guidance without actual literal commitment to keep the interest rates low if inflation takes off unexpectedly allows for essentially large future unexpected rate increases. And if there's going to be large future unexpected rate increases, you're going to get shocks to stability through the fact that banks will take decisions to lead to insolvency. So again, low for long beliefs reduce long-term interest rates, but they also apply very little interest rate risk of buying long-term bonds financed with short-term deposits. Okay, so large unexpected increases can lead to unstable financial institutions. And then if you actually do have to raise increases, you'll be back in the A versus B choice that I just talked about. Once you've had forward guidance, once you've flattened the yield curve, you're either going to get financial instability, which will make monetary policy work very fast in an unintended way, or you're going to get constraints on your future monetary policy. So the whole point of this is if you actually have constrained future monetary policy, you will get some inflation, but then you won't be able to deal with it. But because this wasn't actually a commitment, you get into this thing where you've promised not to raise rates, but you need to do it. And that's how you get financial instability. Okay. So the idea is so there's a question which we thought about, Raghu and I thought about in the 2012 paper. Does this thing that worked like QE, we didn't call it QE in that paper, but that we had a strange monetary policy there that was essentially QE is the only thing that you had. So essentially, QE is going to flatten yield curves. So the idea is, if you have a very upward sloping yield curve, and you look historically that the slope of the yield curve basically predicts a high term premium, the high expected return from borrowing short and lending long. An upward sloping yield curve would seem to encourage this interest rate risk buildup that the Silicon Valley took. Now, they were borrowing short and lending long with a very flat yield curve. They were only picking up less than 100 basis points of yield, but I guess their point was it's better than nothing. But I guess my point is, if they really believed that the yield curve was going to stay flat and low for a long time, they were picking up these nickels, these small increases in yield by going out the yield curve at essentially no risk. So you could think that flattening the yield curve would reduce interest rate risk taking, unless at the same time, the reason the yield curve is flattened is because the monetary authorities have convinced the market that they're going to not raise interest rate risks. So a flatter yield curve works in one of two ways, or some combination of those two ways. A reduced term premium. The reduced term premium should reduce the expected return from the strategy of borrow short and lend long in liquid stuff, but only if banks perceive this reduced term premium. If you just flatten the yield curve and banks believe the historical unconditional result that a term premium is an expected return premium much more than it is a forecast of future interest rate increases, then maybe even this first thing that would say flattening the yield curve should reduce the taking of interest rate risk in the borrow short, lend long financial sector, maybe even that doesn't work. The second point, which is related to the low for long and forward guidance point, is that if you think that QE flattens the yield curve because it signals even more strongly than just saying low for long or just saying there won't be an increase. If you think it's a signal because maybe central banks don't want to lose money if they have a lot of longs on their books, or because this is just giving a second type of commitment other than just words, this low for long component is going to encourage short-term funding and its risk. So I'm arguing that maybe Raghu and I were right, that these things like QE and promises of low for long potentially have financial instability implications. They have a lower financial instability implication than ex post bailouts of equity holders, but which, let's say if you get into a problem where interest rates are getting very, very high, you just lower interest rates to recapitalize banks. That is a stealth recapitalization. It's not as bad as actually just writing the equity holders a check. So there are issues. I think monetary policy in general has to think more about whether these things like QE and low for long are ways of trying to fool the market rather than just forecasting what's going on. And I think fooling the market basically is a repudiated strategy for most modern monetary policy views that I'm aware of. Okay, so just a couple of seconds on looking at the yield curves in the Eurozone. So we can see in 2020, the very bottom of this thing, the dark green is the 2020 Eurozone yield curve. So it was remarkably flat. It was basically negative for the whole time, for the whole period here. So there probably wasn't a very big incentive in 2020 to borrow short and lend long, particularly if you're borrowing in terms of deposits that are paying zero. So there wasn't a buildup in 2020. So we see in 2021, the yield curve is going up a little bit. The long end is at least going more positive here. So maybe the initial view is going to say, well, because the yield curve's relatively flat here above zero, there shouldn't be very much risk taking in terms of interest rate risk. And we could also say that if you looked at this yield curve as a forecast of future spot rates, you can pretty safely predict that the ECB is not going to be raising interest rates anytime soon in 2022 or 2023. And we have problems where there's not enough inflation, and we really have committed ourselves to keep the rates low. So then we sort of see in 2022 and 2023, these are all September yield curves, by the way. In 2022, we see interest rates have gone up across the board. Even the short rate is positive. We have a relatively flat yield curve, but if you just look, the whole yield curve is way above what it was in 2021. So if we think of the forward guidance, we think of the QE, we think of that in 2020 and 2021 as saying, take interest rate risk, it's a profit opportunity with relatively low risk. We're very much not in trouble. We get 2023 and we see we are in a bit of trouble. So let me summarize this argument. Not marking to market is going to set up essentially some type of a solvency run on uninsured deposits. Unless there's a temporary increase in deposit insurance, when we have common knowledge that a significant part of the financial sector is insolvent, this is going to lead to contagious runs. Okay, so the United States introduced ex post 100% deposit insurance in the insolvent banks, first Silicon Valley and then First Republic, with the implicit view that this would happen if there were runs elsewhere. There was some discussion that deposit insurance might be increased more generally. I think actually, personally, it's better to have these discretionary ex post increases in deposit insurance when there's a run than to explicitly have 100% deposit insurance. Why? We already learned that that supervisors are not very good at closing banks that are insolvent when they are at interest rate risk because they don't mark things to market, they're only paper losses. So if we had 100% deposit insurance, let's say on Silicon Valley Bank, we wouldn't have had the run there that woke up the supervisors to the fact that they had been not making a very good decision in not marking these things to market. We can learn from the savings and loan crisis in the United States when they didn't close the insolvent savings and loans. You can't count on supervision and regulation necessarily to close insolvent banks when the issue is interest rate risk. So deposit insurance, when you introduce it in after the fact, it's sort of like suspension of convertibility. It probably doesn't have moral hazard because you can wipe out the equity holders. And it's not going to have any effect on depositor monitoring because even large depositors don't monitor very much. So 100% deposit insurance, when you can introduce it, is a good idea. Now, what does this say in the Eurozone? Well, it's much harder in the Eurozone. The way deposit insurance is very low, the way it's very national, and it can't respond quickly. I would say that the Eurozone should be even more diligent about keeping their banks solvent, because if this solvency thing ever becomes an issue, you saw it during the sovereign debt crises things, that it could be a thing for financial instability. So at least putting a limit on how much Eurozone ignoring of interest rate risk should be an important thing. So low for long commitments that have problems. So essentially, we need good supervision, including mark to market. We need to make sure banks are well capitalized. If banks are well capitalized, we can keep financial policy, financial stability policy separate from monetary policy. Monetary policy can then work with its normal long and variable lags rather than the fast ones that occur when you cause a financial crisis. So that essentially is the message I want to deliver, and I thank you for listening.
Thank you very much, Professor Diamond, for your clear and insightful presentation of a highly policy-relevant topic. We now open the floor for the Q&A session. We have about 15 minutes. I will first collect questions from the audience, and then we'll shift to the chat from our virtual audience. And please, when you ask your questions, identify yourself and your affiliation. Luke.
Thank you, Fabio. Thanks, Lark. Great to see you. My name is Luc Lave. I'm here at the ECB. So I wanted to challenge you on the importance of mark-to-market a little bit. So even if there were no mark-to-market accounting and I look at SVB, am I right to conclude that it is rather odd to take large deposits and put them in agency securities? I would call such an entity a mutual fund at best, but not a bank. And as a consequence, I would also not enjoy deposit insurance and we would not have some of the problems that you alluded to. So I think this follows maybe a little bit from the second part of your story, which is what was the welfare benefit we get from this entity. It doesn't do loan monitoring, etc. But so my question is, should we actually allow banks to invest in this type of very liquid securities to begin with? Or should we actually, as supervisors, also curtail that and in that way take away a lot of the interest rate risk that you spoke about?
So that's a good point. So again, my point is that this doesn't add value, gambling on interest rates. And when we supervise money market funds, we don't let them have essentially in the United States, and I think in Europe as well, essentially any large interest rate duration gap. So if this were a money market fund, they wouldn't be allowed to do anything close to this. On the other hand, we have liquidity requirements that essentially encourage banks to hold more liquid assets. And even longer term government securities are treated as liquid assets. So if we're going to allow these things to be held, essentially we have to measure the ex-ante interest rate risk that banks are taking. And if the ex-ante interest rate risk is very large, they should be disallowed from taking this risk. Okay, so that's sort of your point. But I still think it's the case for any asset that has a totally reliable market value. I think ignoring the effect of solvency on marking by not marking these things to market, even if there's a relatively small interest rate duration mismatch, interest rate gap, ignoring this type of loss that's not marked to market, if it gets to be a significant fraction of capital, is making a big mistake. So you could say that banks could only invest, let's say, one thing you could say is banks could invest in loans and central bank reserves, and that's it. So that's one thing one could do. That would prevent any interest rate risk, as long as the interest on reserves payment is not tremendously confiscatory, that could work pretty well. But presumably banks do other things, even though, the way I like to think about them, they do a lot of this loan monitoring and liquidity creation. They do other things. So they have, they have broker dealers and things like that. So I think probably measuring interest rate risk in advance in a better way is important. But measuring it ex post and making sure that you don't have an insolvent bank, which you need market prices to do, as long as you trust those market prices, which supervisors and regulators don't, I think you're going to want to leave that as part of the policy tool.
Yes, I'm Giuseppe Ferrero from the Bank of Italy. So I was thinking about your point about forward guidance and flattening of the curve when you are in a low interest rate environment. But let's think about now that we are in a, let's say, relatively high interest rate environment. A flattening of the curve where you bring up also the longer part of the curve through the forward guidance would have the same implication, maybe not for banks, but for other financial institutions that have the opposite maturity transformation. So what is your view on that?
So the opposite side is that I'm not going to lower rates for a while so that the volatility is fairly low, at least for rate reductions. The interesting thing is when we were in very, very low rates, it was sort of a two-sided guarantee because we were sort of at the effective lower bound, and there was guidance to not increase rates, to sort of almost promise not to increase rates. So in the current environment, it's only one-sided. Presumably, if inflation started to get even larger and you needed to keep real interest rates from going more, below where they are now, you do have the upside risk, but if you think it's a one-sided bet, presumably there are certain financial bets that look like they're very low risk. So I actually hadn't thought too much about the long-term thing. So I think there should be the paper of Rajan and Raghu and mine basically said, moving the interest rate risk distribution thing around is a good idea, but putting a floor that actually changes the mean of the distribution going forward for stability reasons has its issues. So I think your point is that one needs to think a little bit more about what you're going to promise in the future about interest rates. So I think the kind of thing that is a little vaguer of saying policy will be data dependent, which is sort of promising some particular function of future inflation news and future output news, sort of, like saying something about your future Taylor rule. I think that is more in the spirit of enhancing financial stability than saying the nominal rate will not do the following thing. But I think you have a good question, which I need to think more about.
Fascinating presentation. My name is José Luis Pedro from Imperial College London. So you were talking about monetary policy and interest rate risk in the United States, where most of the loans are fixed rate, apart from the liquid securities. In Europe, and loans to corporations are variable interest rates, most of them. And in some countries, mortgages are variable interest rates, or in the UK, after 2 years, they become variable. In this case, the interest rate risk is in the households or in the firms. And therefore, when interest rates go up, there is a credit risk. It's not an interest rate risk, it's a credit risk. And do you think it's equally important? And do you think who holds better the risk? Who bears better the risk? Households and firms or banks?
So it's a little, so I agree with everything you said. So I think actually in the US, more business loans are actually floating rate. It's sort of not that different from in Europe. And this thing about credit risk is highly important. So, I mean, if you have a loan to a subprime borrower, or you have a loan to a highly levered firm, and you try to raise the interest rate above the one they can pay, the interest rate risks do convert into credit risks. So, you know, to the extent that you need to measure that, and those things need the supervisory equivalent of marking to market to make sure banks are solvent. So that the separation of interest rate risk and so even if you impose it on the households, if you impose it on the firms, it blows back on the banks if interest rates go up enough. The point I sort of implicitly made before is there's also this, so in the US, I don't think it's a big deal of whether the interest rate risk gets imposed on the US federal government or not, or US government agency securities or not. So there is this thing, if let's say you did a huge amount of mark to market that discouraged European banks from holding longer term European government agency, European government bonds, and they switched to shorter maturity, that would then transfer the interest rate risk to the sovereigns. And for the lower rated, potentially lower rated sovereigns, that could bring back exactly the point that you're just raising there. So in the Eurozone, it's a little less clear that the banks aren't doing any extra risk sharing by holding longer term government bonds. I don't think they're doing any of that in the US government bonds or agencies. So I don't, you know, I still, mark to market when you have a good price, I think is essential. If it's not in the formula, at least in the discretionary part of bank supervision and regulation, it's essential. And no matter what type of contract the banks in Europe are writing, you need to try to measure these risks, particularly, you know, the ex post solvency things, which lead to the potential instability to do a decent job.
Thank you. We have now time for one last question. Viral?
Yes. Hi, Doug. This is Viral Acharya from NYU Stern. Great to hear your lecture, as always. I had one question on this comment that's coming up frequently, that the mark-to-market losses could have been either easily calculated or that they were already reported in the footnotes of some of these quarterly filings. Now, the accounting experts do say that, you know, attention is not paid as much to the footnotes as to the actual numbers which are stated in the reports. But I wanted to bring here the role of the federal home loan banks into the scene, and I wanted to understand what's your take on them. Because it seems that even though SVB and other banks were losing deposits, they were effectively getting rerouted through government money market funds back to these banks via the federal home loan banks at a higher interest rate, but they weren't sort of losing funds, even though they were losing deposits. And ultimately, the only point at which they stopped having access to the funds is when the tangible common equity was going to fall below zero, because then federal home loan banks can't lend to them anymore. So it seems that this is a very sort of strange system at some level in which everyone's reaction is now coordinated around access to a sort of quasi-lender of last resort. And you know, I can just see that this is going to play out like no problems for a long time, because everyone thinks that someone or the other is giving you a lender of last resort without any strings attached. So do you think this is just an interesting detail, or you think this is central to the way all this has panned out? And if yes, what would you do about the system?
So actually, I think this fits into this view of the dangers of not marking bank capital to market. And how does it work? It works in the following way. Interest rates go up. I lose some deposits, not because I'm in any financial trouble, but because the CFOs have something better to do with their money. I now effectively get money from the Federal Home Loan Bank. The Federal Home Loan Bank charges market interest rates. So when you're using the Federal Home Loan Bank, the deposit beta is 1. So that starts this vicious cycle that I was sort of describing. Interest rates go up, I lose the cheap deposits, I replace them with expensive deposits. My solvency is now going down, down, down. I mentioned deposits were flowing out and interest rate costs were going up at Silicon Valley. That's how they did it. So if they had been forced to keep themselves solvent at mark to market, they then would have been able to keep raising deposits in the normal, uninsured, much cheaper, low deposit beta market. When they had to move to the home loan bank, that pushed their deposit beta up, made their actual insolvency occur. Book value of equity went through 0. So the problem is, I don't think the federal home, and then what's the problem with the Federal Home Loan Bank? So the Federal Home Loan Bank, this is a problem that used to be more of a problem just with lender of last resort in general. The Federal Home Loan Bank takes a collateralized senior position, right? So they don't really give a damn if the bank is solvent, because their claim is low risk, because they're putting senior debt there in above essentially everybody else. So they're perfectly willing to lend. They don't really do anything very useful. They don't monitor anybody. They just look at their formula. So having 2 lenders of last resort is probably a bad idea. So I'm actually on board that the Federal Home Loan Bank is a large part of the problem, and not because they stopped lending, but because they allowed effectively the insolvent bank to continue to operate for a longer period. So I think, re-examining the role of the Federal Home Loan Bank, of just becoming just a general lender and having nothing to do with home loans is probably a very good policy thing for the United States to undertake.
So our time has finished. We are almost perfectly on time. So let me thank you once again, Professor Diamond, for accepting our invitation and for your very interesting presentation.
Thank you.